Hey, 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 it's Friday. Hello, audience. How y'all doing? Welcome to the clubhouse. Everybody, come on down, have a seat. For those of you guys who don't know me, my name is Jessie Lynn. I am a triangle realtor with Agency Realty. Miss Nicole, introduce yourself, honey.
Hi, everybody. My name is Nicole Crawford. I'm a realtor with Keller Williams Realty out of the Greensboro Triad area.
Awesome. Look, y'all, today we are talking about loan types. We're talking about loan types. So many people, they want to buy a house. They know the steps, they know the process, but there are so many different options out there. We have different loan types. So we're going to go over that today. We're going to talk about it, and we're going to also talk about it from a realtor's aspect, I guess. Yeah, we're going to do that. So, yeah, Nicole, the market is changing. So we're going to have a different response today compared to, we would say, a month ago. The market has changed so much. I had a buyer, they called me the other day. They are doing a VA loan. So Erica just came in the studio. Hello, sunshine. Come on in. Slide over on the couch, girl. Slide over. Sit down on the couch. Okay, look at them curls. They are popping, honey. They are popping. So, Erica, I was just telling the audience, we're talking about different loan types. So I'm glad you're here because you are a lender. So we're going to talk about it from a lender's and a realtor's perspective. The market has changed so much in about a month or so. So we're going to talk about it, Okay, so let's go. Okay. The first one is a conventional loan. So let's talk about it. So let's start with the credit score. And we're going to also talk about, how it benefits the buyer in a way. So let's talk about a conventional loan. Minimum credit score.
Your minimum credit score is going to be 620. Keep in mind that it's going to depend upon the lender that you're working with. Different lenders have different requirements. So there are some lenders which will tell you that the minimum credit score is 640, and it is for that institution. But the actual guidelines are 620.
Awesome. So, Nicole, if a buyer decides to use a conventional loan in this current real estate market, or let's talk about the one in the past also, do they have a chance? Do they have a chance, honey?
Absolutely. Sellers love the conventional over some of the other options for different reasons, but they don't have a lot of the safety stipulations as far as the inspections or the repairs and stuff needed on the home. Is why a lot of times they look at conventional over the others.
Definitely. Okay, so when you talk about inspections and repairs and all of that, what do you mean as far as that whenever it comes to the loan?
Well, with some of the other loans, they are looking for safety issues. That's a big factor on a lot of the other loans. So with conventional, we get a little bit more grace. And we find that we don't have those things to come up as often.
Erica, what are some safety issues that you see that kind of comes back that your people kick out?
So with conventional, like she said, you don't have as many. A lot of your government loans, things like chipped paint, which it may not be a big deal to us. And you're thinking, oh, I could just touch that up. No, the government is saying, no, you can't. That has to be fixed before the loan can close. So it can be little things that we feel like, oh, it's not that big of a deal, or it could be a chip on a window or something like that. But they look at all of those things when you're talking about government loans, and your government is going to be your USDA, your VA, and your FHA loans.
Okay, so I'm going to move on to the next one. I just heard someone walk in, so I'm going to see what they need really quickly. So let's talk about an FHA loan, and let's talk about the down payments and all of that. A lender versus a real estate agent, and let me go see what they need right quick.
Okay. Well, an FHA loan has a down payment requirement of 3.5%. Depending on what your credit score is, that's going to be the case for most people. FHA does go down to 500 as a minimum credit score, but you do have to put down 10%, and not a lot of lenders actually have that product. So most of the time you're looking at 3.5% is your down payment piece of it, and your minimum credit score needs to be 580.
Right. And from a realtor standpoint, a lot of the clients that I see are approved quickly with FHA because of that lower credit score requirement. And it's not a bad thing. It just means that we have to work within the restraints of the loan that we are giving. That's what that is.
Right.
So I just came back in. I don't know what y'all talking about, but let's talk about bankruptcy. Can you, with this loan and with the conventional loan, can you get this loan if you file bankruptcy? Let's talk about Chapter 7 and Chapter 13.
You actually can get a loan on either of those options. If you have filed a Chapter 7 bankruptcy, it's going to be different for each loan type. With a conventional loan, you have to wait 4 years from the time that you have been discharged or dismissed from a bankruptcy, and that's from conventional. Chapter 13 is 2 years from the discharge date or 4 years from the dismissed date.
Sorry, you still talking. Go on.
I was going to say, so FHA is 2 years from discharge date on Chapter 7 and 12 months since the filing date. But you do have to get permission from the bankruptcy court for Chapter 13. VA is 2 years from discharge date and still the same 12 months from the filing date. And USDA is 3 years from the discharge date on a Chapter 7, and it's still 12 months since the filing date on a Chapter 13. But again, you have to get permission from the bankruptcy court, and you can't have any late bankruptcy payments.
Okay. And look, y'all, we'll mention it again whenever we get to the loan type also. So y'all talked about FHA. Y'all talked about the down payment amount for FHA.
Yes.
Y'all talked about repairs and all of that, and why it's different from the conventional loan.
Right.
Correct. Awesome. So question, foreclosure. If I've had a foreclosure, can I get a FHA loan?
You can still get an FHA loan.
And it's what?
So for an FHA, it is 3 years from the date of foreclosure, 2 years for VA, and
I think we're on conventional.
I'm sorry.
Go back to conventional. Conventional. What about conventional?
Conventional is 7 years for foreclosure.
Yeah, let's see that. Okay. Awesome. So, all right. So for me, y'all have heard my story. I've had a bankruptcy. I've had a repo. I've had a foreclosure. I've had all of that. So yeah. For me, I went through state employees, and I think for me, I got it probably about 7 years. So right after. So yes. So let's kind of go on and go to audience. Do y'all have any questions before we move on to the next one? We're on conventional and we're talking about FHA. So I got a question for you. I see that they have the same stipulations anyway, for the most part. So it says conventional Fannie Mae, and conventional Freddie Mac. Is there a major difference between those two conventional loans?
Not a major difference, no. And they're just two people that they both offer the scenario. There are some times where guidelines may be different. So just like this weekend, they're actually supposed to be tightening guidelines for Fannie Mae.
Okay. So I'm sorry, go on. What are they changing? I'm sorry.
Well, they haven't told us what they're changing. They're just saying that they're changing the DU requirements, which is the system that they use to score whether you've been approved or not.
Awesome. So audience, if y'all have any questions, we're talking about the different loan types in real estate. So Nicole, so far FHA, your clients, pros and cons of an FHA loan in this market, if you haven't already talked about it.
Well, I didn't tap into that one, but what we've seen for the past couple of years is that sellers are really, really not liking the FHA loan because they don't want to make repairs. They don't want to get caught up in those scenarios where, the loan has to be terminated because nobody can or is willing to make the repairs. With the market changing, I am seeing more FHA offers being accepted. That's the great thing. That's the one thing we're all just kind of cheering about, because a lot of my clients, that's the loan type that they qualify for. And going conventional is kind of not an option without a whole lot of work and a whole lot of money. So with that being said, to see this market changing and us getting those offers accepted for FHA is exciting again.
Definitely. So, and the difference is right now is for an FHA, you only need a 580, and for a conventional, it's a 620. So
I will say another thing with the with the requirements, you're looking at 3% down. For conventional, they have first-time home buyers, which gives you 3% down as opposed to the traditional 5%.
Awesome. And also, so let's talk about this maximum loan limit. Does that really matter also, or is that like, have you seen anybody that? Because I'm looking at what 314 for FHA, and that could have changed because this is the old sheet that I'm looking at, and the maximum for conventional Fannie Mae and Freddie Mac is about 484, 350, somewhere in that area. Or does that matter these days?
So both of those have changed. And I will tell you that FHA is going to depend on the county that you're in. So just like if you're looking at Durham County and Orange County, that limit is higher than it is in Wake County or Guilford County. So, so it's going to depend there. And as far as the conventional, I think it is 464 right now. Is the loan limit for that.
Okay. And so, Nicole, let's kind of go back to what you were saying earlier. You said that a lot of the sellers, they are afraid of the loan or whatever. They're afraid of accepting the FHA loan. So what makes them afraid? Is it that addendum that they have to sign?
The addendum does play a part in it because the sellers are looking at the fact of the appraisal. So the addendum, I'm hoping that's what you're referring to, is the FHA addendum. Okay.
Yes.
So the addendum basically says that if the price of the house, if, for instance, we offer 180, the addendum says that if the house appraises lower, then the buyer has the right to terminate. Well, one thing about it is, in the market before, nobody wants to terminate, and we were making offers that were well above list that probably were not going to appraise. So they didn't want to take the chance of having a property that now doesn't appraise, and we also get stuck with the fact that our next offer cannot be an FHA offer because that appraisal is going to stay with that house for a certain period of time. So with that being said, sellers didn't want to have to deal with that.
So as a real estate agent, and we do have some sellers in this group, how would you speak to your seller? How would you talk to them about a client, an offer with an FHA loan?
Absolutely. So the one thing about it is, I think there's pros and cons to every loan. The one thing that we want to make sure is that particular client, we can do our due diligence as an agent to call the loan officer. They don't have to tell us everything, but they can offer us up if that client is a solid client and they've been through certain aspects of their pre-approval process and where they are in that. So if you're taking an FHA offer, those type of things we can already do. I'm looking at the seller and asking them about the repairs that we know that need to be done on the house. We can always have it pre-inspected so that we know what's going to come up, and that it doesn't hit everything, but it's going to hit the big things. So those things we can go ahead and take care of, and so that way you're not get hit with that stuff later on. Those are the things that I tell my seller, if there's questions, let's go ahead and do it beforehand before we ever put it on the market, so we don't have to worry about it later.
Okay, awesome. So let's go to the next one. We have VA loans. Again, this one right here is a little bit tougher, but let's talk about the benefits of a VA loan. So let's talk about the credit score. What's the credit score for a VA loan? The lenders and the
VA. Most lenders are going to be a 580, but technically there is no credit score requirement for a VA. But like I said, most lenders have their own requirements as to what they will do. And so I know for us it's 580, but there is technically not a VA score requirement.
Okay, so what's the down payment? Down
payment is 0 for a VA loan, which is a great thing. It's a great product for our veterans or, families of veterans. So, you have some people, widowed, those type of things that can also take advantage of the benefit. And with, depending on if they have a disability rating, sometimes they can also lower the fees that they'll have to pay. So it's a really good product for us as a lender.
Pros. So
definitely get some people in there without having to put a lot of money down.
So are they required? Let's talk about this thing called mortgage insurance.
Okay. So mortgage insurance is basically there to protect the lender in the event that you default on this loan. So that's something that you will have with conventional financing. You have a form of it with an FHA loan, but you do not have that with a VA loan.
That's a benefit. Okay, awesome. And let's talk about with the bankruptcy and a foreclosure. Can you get a VA loan with the bankruptcy and the foreclosure?
You can do it with both. So what you're looking at with that is going to be your time frames are just going to be a little bit different.
Okay.
So that's the biggest part of it with that. So.
All right. So for those of you guys that just tuning in, we are talking about the different loan types. We are talking about your credit score. Can you get a house with the foreclosure? Can you get a house with the bankruptcy? And what are some of the pros and the cons on the different loan types in this market? So Nicole, as a real estate agent, what are some pros and some cons of a VA loan?
Well, I think a lot of the sellers stopped accepting offers with VA because of the requirement for the pest inspections and things like that that normally the seller has to pay. But it was really sad that our veterans could not get their offers accepted for those reasons, because there was some seller paid closing costs and things like that. But for me, anytime I have a veteran, I try to push as hard as I can and see what we can do in those offers to make them look even more enticing than the conventional.
Definitely. I know some companies, and I know Erica said they just started doing this, but back when the market was very competitive and it was hard for a VA loan to get accepted, we use other options like the cash options to appear that you're making a cash offer and you're still able to use it. Although I know with Ribbon, the sellers are still required to sign that addendum, but they feel a little bit more confident because they guarantee that they will close. So that was the biggest thing for them.
Yeah, all right. I would say on our end, like when we do the cash offer, it's just a straight, as far as the seller's concerned, it's just a straight cash offer. So you don't have those additional pieces in place. So they don't know that it's a VA loan or an FHA loan. They don't know what kind of loan you're getting. They just know that we are buying the house.
I wonder if you are as far as a VA loan, you know how some lenders, they do a lot of the underwriting up front, and that'd be a good benefit as well to say, hey, look, this is the situation. But that may make their eyes light up a little bit because they can close in about 7 days or whatever. But are they willing to make that sacrifice to do those repairs? But it just depends on the age of the property. And that's definitely something that the buyers, I have a buyer who just called me a few days ago. He's approved for a very low amount. So that's going to be an issue, especially in this market with properties needing repairs and all of that. So that's definitely something that you want to take into consideration whenever you are thinking about using your VA benefits or getting the VA loan, because some sellers are not willing to do these repairs in this market.
And I will also say shop around for your lender, just because that may be where you got approved at a different lending institution does not necessarily mean that's going to be your amount at every lending institution.
Definitely. All right. So the last one that I have is a USDA loan. What's a USDA loan? I know for me, I live in the country. I used to, when I first got into real estate, and I still get it a lot now. Sometimes they want a USDA loan. They want a USDA loan. They want a USDA loan. Why do everybody want a USDA loan? Erica, or why do you think they think they want a USDA loan? Let's just say that. Why do you think they think
it's a no money down option? It's a no money down option, but a lot of people confuse no money down with not needing any money for the home, which is totally different. You still will have to pay for your closing costs, things like that. And back in the day when you had a lot of seller paid closing costs, that was a very low cost option, which will allow you to get a home, but you have to meet the qualifications. And that's the part that a lot of people miss, is that it does have qualifications.
And what is the credit score amount? Because I think USDA has a higher credit score than most right? Like
It actually
640,
doesn't. It's still 580.
580. Oh,
Mm-hmm.
this sheet
Still
wrong right
580.
here.
But again, depending on the lending institution, there are some lending institutions which their credit requirement is higher, but as far as the actual guidelines are 580.
So y'all hear that? It depends on the lender and their guidelines. So that's very similar to the whole VA and all these other government-backed situations. So that's why it's important for you guys to shop around. If one tell you no, it doesn't mean the other one is going to tell you no.
That's exactly correct.
So that's awesome. Okay, so you said no down payment is required with the USDA loan, right? You just said
That's
that.
correct.
All right, so
a couple of things I will say that you have to remember. So you have to meet the income requirements. So they do the income for your entire household. Anybody that is over the age of 18, even if you have people under the age of 18, they still will look at that income as part of the household income. So if you have one person that is working and wants to be on the loan, the other person is working and does not want to be on the loan, their income is still included into the household income.
Awesome. And let's talk about so what about the bankruptcy and the foreclosures? Can you get a USDA loan with the bankruptcy and foreclosure, and what are the times?
You can. So all of the options, if you have bankruptcy or foreclosures, it is an option to get a loan. Your waiting period is different for each individual ones. USDA is 3 years from the discharge date for Chapter 7 and 12 months from the filing date with no late bankruptcy payments and permission from the bankruptcy court if you're still within that bankruptcy for Chapter 13.
Awesome. So, Nicole, what are some benefits, pros and cons of getting a USDA loan for your clients?
Well, we always love when we can do USDA and there's 100% financing. I'm finding that a lot of my clients, when they go to get approved and they hear 100% financing, they jump on it. But then they're disappointed because the house has to qualify. So the house has to be in a certain area, and it has to be within the area that USDA deems rural area. So I know for Guilford County, that's a very limited amount of area of our county. Matter of fact, it's more of the counties next to us more than Guilford County. We have small spaces that are still USDA qualified. So that's the big thing about that. I mean, I love the program myself, but finding homes, and especially in this market, it's been hard, and it's getting harder and harder because those lines keep moving.
Well, it's made to populate the rural areas. That's the purpose of the program. So, when you have former farming land or things like that, then those are when they're like, okay, we'll give you some money if you want to move to this particular area. But that's generally not going to be your larger cities like your Charlotte, your Greensboro, your Winston-Salem, High Point. Like none of those cities are USDA territory. Like even in the Wake County area, if you're looking for USDA, you're going to have to go out to like Butner or Stem or Creedmoor or something like that. So those are or Johnston County. Those are going to be your USDA areas.
Johnston County is almost off the USDA charts.
Yeah. So they have little pockets, which, are, but not a whole lot. And just like there's really nothing in Wake County or Durham County that's actually USDA territory.
Awesome. All right. So we just went over your conventional loan. We have our 620 for your conventional loan, your FHA loan, 580 VA, 580 USDA. You said 580 as well?
580.
No down payment with the USDA, no down payment with the VA, 3.5 for FHA, and conventional varies.
Is anywhere from 3 to 5%.
Is that for conventional? For
conventional, yes.
Awesome. All right, y'all. Audience, do you guys have any questions? If you're just tuning in, we're going over the different loan types. What loans should you go for? All right. So out of all the loan types, you guys, what's the easiest let's talk about qualify for? We had kind of already said that, but what's the easiest to kind of process? Which one has the least issues through underwriting?
I don't know, because every one of them could be different. So Just like your situation with an FHA may not be the same as Nicole's situation with an FHA. So don't go for a particular loan type. That's my job, to see which one is going to be the best fit for you. Because you have a lot of people calling saying, well, I want an FHA loan because I heard it's 3.5% down. Well, once we have a conversation, okay, the better fit for you may be a 3% down conventional loan.
Awesome. All right, Nicole, you got any feedback?
I was going to say, and a lot of times I've seen, and it doesn't happen a lot, but I've had instances where conventional, we've gotten credit repairs on the appraisals and had to do them, or I've had the bank to come up with something that had to be repaired, and it was a must. In those cases, I've had the bank to allow my buyer to say that they would fix it, but it had to be done before closing, which is very risky on a buyer's end.
I'm with you. I have my pros and my cons with all of them. Because like you said, I've had a conventional. I had to have some stuff fixed. BA, some moisture. Like you said, with the whole termite situation, we had to get that fixed. And with the whole USDA thing, what about the septic situation? Y'all want to mention the septic with the USDA?
It's your septic has to be up to par, all of those things with the USDA.
So you're required to get a septic inspection.
Right. And it has to make sure it passed that inspection. It also has to be a certain distance from the well. So there's, all of those pieces have to be in place.
There you have it. And if you're getting a USDA, you're going to most likely have a septic. Well, I'm not going to say that, because I know some years ago when my sister purchased a property, it was in Clayton and it was downtown, and it didn't have a septic. So it's not always the case, but if the area is up and growing, you may have a good chance of not having a septic.
Absolutely. Because like Reedsville and Eden, a lot of that is still considered USDA, but they're on free services. So that's why once my clients are looking and they're willing to go outside of Greensboro, those are really, really good options.
Yeah, I haven't had a lot of clients with USDA. But like you said, when I first got into real estate a long time ago, when I had the client, no septic, but then I had another one that had a septic, and it's just like, okay, we got to get it inspected at the very last minute. So that's why, with the lender, your lender, it matters, because that, for me as a real estate agent, I may not know that, but as the lender, that's something, we should, okay, is a septic in here? We need to make sure we're ordering inspection, because a lot of the times it's USDA, they have low income, not always, I'm not saying that, but some people, they need all of their money and they may not be able to afford a septic inspection.
Right. And then just things like USDA doesn't do existing mobile homes. So it can be a new mobile home, but it can't be an existing mobile home. So those are things that, as a lender, as a real estate agent, that, kind of to steer your clients. Okay, listen, this is not a house that you want to look at with your particular loan type.
And that's why I didn't even know that. That's why it's important, because a lot of times clients, they want to understand why we want that pre-approval letter before going out. Why are we shopping if we don't know what the loan type is? That helps us to determine what houses we really should be sending. If it's a house that's not going to fit your loan type, why are we wasting our time unless you do have the capabilities to switch loans? So it matters. It matters.
It does.
Well, and the other thing with the pre-approval is you have to know how much house to show them, because just like they think they can afford a $200,000 house, and they, based on the rent that they're paying. But, we look at different criteria when we look at the different loan types. So it's like, okay, but we're only willing to lend you $150,000. So unless you had this other $50,000 to make up the difference, I'm gonna need you to stick in your price point.
Exactly. Well, audience, if you guys don't have any questions, I think that was a good one today. I enjoyed that topic. I really did. But it's so many questions. We do this like every week, but I'm just amazed at some of the questions. So I'm just like, okay, so this was a good one. And I hope that it helps somebody today. For those of you guys who don't know me, my name is Jessie Lynn. I am a Triangle Realtor with A to Z Realty, and you can reach me at 919-818-9854. Miss Erica.
Hey, and I am Erica Batts. I'm with New American Funding. I'm your loan officer. You can reach me at 919-608-7916 or at ericabatts.com.
Nicole.
I'm Nicole Crawford. I'm a realtor with Keller Williams Realty. I service the Greensboro Triad area, and I can always be reached on my cell. It's 336-457-3007.
You guys, you can reach all of us in the clubhouse at www.thehomebuyersclubhouse.com. You can also find us on Facebook I can't get that right every week. You can find us on Facebook in our private group or on our page at Home Buyers Clubhouse. And you can also find us on YouTube at The Home Buyers Clubhouse. You guys have an awesome weekend. We'll see you guys on Wednesday. We'll talk to you guys later.
Happy Friday.
Bye.